Hello and welcome to CNBC TV18's Mumbai Newsroom. I'm Samira Avdi and you're watching Your Stocks. Our two experts joining in today. We have Gaurav Ratnaparkhi, who's a technical analyst at Sharekhan, and Parthiv Shah, director at Tracom Stock Brokers, will be answering all your stock queries. Gentlemen, good afternoon to both of you and thanks very much for joining in. The first query today is coming in from Chennai, and on the line we have Mr. Vaidyanathan R, who's called us. Hi, sir, good afternoon. How can we help you?
Good afternoon. I was just wondering about LIC share, and I bought it after the IPO at 8.15. I bought 20 shares, and it seems to be grunting and just doesn't move beyond 700. So I was just thinking about the short term and long term for that share. And the other one was Indus Towers. That also I bought about 50 shares at 213. And I was a little optimistic that, okay, 5G will push this forward, but I haven't seen much of a movement. I just wanted to know the long-term and short-term perspective of both these shares.
Absolutely. Parthiv, let me come to you first. He's making losses on both investments. But at the moment, the loss doesn't seem to be too worrying. Should he remain invested, or do you think he should probably look elsewhere?
Good afternoon, Sumera. Regarding his view for the short term, probably I won't be the best person, but yes, he has even seeked a long-term view. Firstly, about LIC, I believe that over a longer horizon, this stock will rebound back. One of the reasons being, we know for the fact that they are the market leaders and they are doing a lot of new things in terms of trying to launch a lot of non-par based policies, which are always margin accretive, and even in terms of the VNB margins, value of new business margins, as compared to the pre-IPO days where they used to hover somewhere around 8-9%. Now it's slowly gradually inching up to 11-12%. And I believe looking at the channel network and looking at the network size that they've created of the agents, I think they will be in a very good position to distribute a lot of non-par policies that will really help over the longer horizon. But it'll take some time to materialize, because I think at this juncture, probably with such a big IPO, which has not really done well for the investors, it's more like a forgotten stock. But as and when I think the quarterly earnings kick in and we get to know more about the data of where they're headed in terms of non-par policies, I think that will be a trigger for the stock. So over a 1 year, 2 year horizon, I believe that there is upside in the stock. So hold on if you are a long-term investor. Talking about Indus Towers, the thing is, here we have already seen a lot of consolidation take place. We saw a lot of other companies, towers, getting merged into this company, and eventually they have very big customers like Bharti Airtel, Jio, and Idea. And even in terms of Idea, I think one was writing of that Idea contributing almost 27% to the revenue would not be in a good position to pay them. But I think things have slowly and gradually worked out, and eventually this entire telecom industry is looking at a place where the ARPUs are headed up, and we are seeing a lot of new conversions in the higher paying postpaid customers for most of the telecom carriers. And going ahead, the way Reliance has announced almost a 2 lakh crore worth of capex for 5G, alongside even Bharti Airtel will be talking about their 5G capex going ahead. I think that should percolate into better numbers for tower who works on a tenancy ratio, I think, for like Indus Tower. And I believe over the next 2 to 3 years, the valuations could be get re-rated here, and it has a very high dividend yield, which can even go further up as and when the cash flows improve.
Okay, Gaurav, what about you? A nearer term view on both stocks, what would you recommend?
Yeah, so in the case of LIC, the data is relatively insufficient to analyze it from medium to long-term perspective. But what I can see on the chart is that it had a sharp correction, after which the selling pressure got absorbed near the level of 650. And since then, it is attempting recovery. It has not yet recovered fully, but it is in a process of forming a base for itself. So hold on to the stock with the stop loss of 650. As long as it stays above the level of 650, there is potential for recovery. On the higher side, 690, 700 is a resistance zone. Once the stock crosses that resistance zone, it can head towards the level of 760, 770. And as far as Indus Tower is concerned, the structure is not so lucrative from technical perspective. The structure is indicating further downside potential from medium-term perspective. For last 3-4 weeks, the stock is witnessing sideways consolidation, and that is likely to result into the next leg on the downside. On the higher side, 204, 206 is a resistance zone where fresh selling pressure is expected. And from there, the stock is expected to move down towards the level of 181. So it is better to exit from Indus Tower and hold in the case of LIC.
Okay, so Mr. Vaidyanathan, I hope you have taken note of the opinion offered by our experts. The next query comes to us from Bengaluru. We have Manikandan writing in. He says he has 1,200 shares of Reddington, which he has bought at 166. He's making some loss. He wants to know whether to book the loss right now or to remain invested in the hope of higher profits. Gaurav?
Yes, so Reddington has seen a decent upside in last couple of months, but I think if you look at it from medium-term perspective, then the stock is tumbling near its weekly upper Bollinger Band. On the downside, it has a support from its crucial weekly moving averages. So 140, 160 will be the consolidation range for this counter. And if it dips towards the lower end of the range, that is towards 140, at that level, one can add more on the long side. And once the level of 160 is surpassed, then the stock will have potential to head towards 190, 200. So buy on dips at around 140.
Okay. Parthiv, is this a stock you like? What would you recommend?
Oh yes, I think they have a very big distribution network for a lot of hardwares and especially that of the Apple products. And that is one reason why it has caught the fancy of a lot of investors. And they have a fantastic business model which is very much scalable. We have seen what sort of traction has taken place in the country in terms of the mobile phone manufacturing and mobile phone distribution. And Reddington being one of the bigger players in this segment. Not only that, even they have other electronic products and they have collaborations with a lot of good brands. I think that could really help them to scale up the business. So give it some time, no doubt, in terms of the valuations, it is a little pricey. But going ahead as and when the earnings start kicking in, and especially now we are witnessing more of the consumer sentiment being opened up, especially post-COVID. I think next couple of years we can see very good numbers, especially in terms of EPS growth of anywhere not less than 15 to 20%. So that should help the stock to again get its mojo back and re-rate from here.
Okay. The next query is from Utkarsh Gupta, who has written in from Mumbai. He says he has 1,000 shares of Deepak Nitrite at just over 2,600 rupees, and he has 1,000 shares of Tata Motors at 494. He's making losses in both investments. So now wants to know what are the future prospects from here on. Parthiv?
In case of Deepak Nitrite, I think thanks to the fact that there was a huge surge in most of the specialty chemical plays last year, and a lot of them got massively re-rated, despite the fact, say, Deepak Nitrite was doing extremely well in its phenol spreads, phenol and acetone spreads. And post which what we saw was there was some contraction there and the margins did contract and it did have some miss in terms of the earnings momentum for a couple of quarters. But nonetheless, I think the stock has massively corrected from its peak, and that has been the case with a lot of these specialty chemical plays where the stocks have corrected from the peak levels to almost to the tune of 30 to 40%. And currently at this juncture, we find a lot of value in Deepak Nitrite. The good thing is that now that their capex in phenol and acetone is over, they are also debottlenecking to increase the capacity to go to almost 3 lakh tons of production, and this is a complete import substitute product yielding them very good margins as well. And they also have future plans to have more downstream products out of these two segments. So I think this can be a very good value contributor going ahead for the shareholders. So if one has a 1 or 2 year horizon, I think a lot of plans regarding their downstream capex will also get unlocked, and we find the valuations a lot more comforting here and would suggest a hold. Talking about Tata Motors, again, I think what we saw recently was the domestic numbers and the market share garnering that they've been doing. So the standalone business, thanks to the fact that even the CV cycle has picked up, is doing extremely well. This is a little tricky part for Tata Motors because especially historically we've seen whenever the JLR business tends to do well, the standalone business would be struggling and vice versa. No doubt, I think in the overall scheme of things, JLR is a far bigger business. And there are a lot of green shoots there. The management commentary regarding becoming cash flow break even over there in H2, I think that is looking achievable. And they have a lot of decent order book in the luxury segment, especially in the Range Rover and the Jaguar segment. So I think that should help them to gain those 7-8% EBIT margins in the JLR business, which should help overall the consolidated numbers. So we are upbeat on Tata Motors with a 1 or 2 year horizon.
Okay, Gaurav, what about you? Where do you see both stocks headed?
Yeah, so Deepak Nitrite indeed had a correction from the level of 3,000 till 1,700. But at the level of 1700, it had a strong support where the selling pressure got absorbed. The stock formed an inverted head and shoulders pattern and broke out on the upside. And thereon we saw a decent rally, but the stock stumbled near its 200-day moving average, from where it has seen a short-term correction in the last couple of weeks. Nevertheless, again, it is preparing for the next move on the upside. So definitely, I would recommend hold on Deepak Nitrate. And in fact, once the level of 2100 is crossed, can add more on the long side. Eventually, the stock is again expected to head back towards the level of 3000. And Tata Motors is again a hold. In fact, we are positive on auto space in general. And this particular counter is expected to outperform going ahead. The stock is currently witnessing short-term correction. It has a good support from its crucial weekly moving averages. So if we get a dip towards 450, 455, again, it will be an opportunity to add more on the long side. The stock has so far retraced around 61.8% of its previous decline. And on the higher side, 500 will be the hurdle to watch out for. Beyond 500, the stock has the potential to surpass even the level of 600 and head towards 620.
Okay, the next query is from Shabir Sheikh, who has written from Andhra Pradesh. He has 200 shares of Sequent Scientific, which he has got at 172. He's a long-term investor and wants to know whether to book his losses or stay invested. Could things turn around for him? Gaurav, what is the target that you have on the stock, and what would you advise Shabir to do?
Yeah, there can be some pressure in this counter from short-term perspective. It can dip once again towards its daily lower Bollinger Band. It can test the level of 100 on the downside. But nevertheless, that shouldn't be a reason to exit from this counter. As long as the stock holds on to the swing low of 82, which was made in the month of June, the stock has the potential to head higher towards 150. So in fact, a dip towards 100 will be an opportunity to buy with stop loss of 82, and on the higher side, 150 will be the level to watch out for.
Okay, Parthiv, what about you?
See, I think I would suggest an exit at the levels that my technical friend has suggested. The reason being that, this company faces a lot of cross-currency headwinds. We know that they have a decent presence in Turkey, and with the Turkish lira kind of depreciating, we have always seen, this company posting very volatile set of numbers. No doubt they are a very big name in the animal veterinary business, which has decent growth potential. But when it comes to execution, I think the company has been struggling, and that's why the valuations of this company tends to gyrate based upon how they report their numbers. But again, I think on any upsides, this is a counter that I would suggest to exit, and the investor should focus on more of the domestic-centric pharmaceutical companies, especially names like JB Chemical and Pharma, where their branded formulation business and all the inorganic acquisitions that they have done seems to give them a good growth trajectory of at least 15 to 20% over the next 3 to 4 years.
Okay, gentlemen, stay on. We're going to take a very quick break. We have more stock queries to answer, but all of that is on the other side. Stay tuned. Hi, welcome back. You're watching Your Stocks. Our two experts are with us. Gaurav Ratnaparkhi of Sharekhan and Parthiv Shah of Tracom Stock Brokers have been answering all our queries. The next question that we have is coming in from Mumbai, and on the line we have Mr. Samir Shah. Hi Samir, good afternoon. What would you like to ask our experts today?
Hi Samara, very good afternoon. My query is regarding that I have 40 shares of Ambuja Cements at 364 and 30 shares of Amara Raja Batteries at 603. So I wanted to know whether should I stay invested in these particular shares or and start book my profits and book my losses in Amara Raja and move out from there.
Okay, but otherwise you're a long-term investor, right?
Yes.
Okay. Parthiv, again, let me come to you first. Ambuja and Amara Raja both. What is your advice for Samir?
See, I think now the fortunes of Ambuja Cements have changed, especially with takeover by the Adani Group. And looking at what could be envisaged in terms of going ahead, the strategy being definitely we are looking at ACC Ambuja merger on the cards, and along with the fact this group will be very aggressive both organically and inorganically, and by debottlenecking, trying to expand the capacities. They've given a roadmap of touching almost 150 million tons over the next 5 to 6 years. And more importantly, I think the synergy benefits, especially in terms of the coal, the logistics, and also Adani Group having a lot of interest in the power business, tends to manage a lot of slag, which is again another important raw material for the cement business. I think there could be a lot of synergies which could help this consolidated entity to save on cost to the tune of anywhere between 300 to 400 rupees a ton, which is probably one of the reasons why it seems they had a lot of interest to foray into the cement business. Currently, the valuations at enterprise value by tonnage sitting at around $166. Our senses with more greenfield and brownfield along with the inorganic capex going ahead, I think this stock should do very well. So give it some time. Cement as such is a sector which should do well along with the India's infrastructure growth. So give it next 3 to 4 years, this will do very well. Talking about Amar Raja batteries, I think here we are preferring Exide Industries more, because Exide Industries has clearly given a very good roadmap in terms of their investments in the lithium-ion battery space. And after garnering a good sum from their life insurance vertical, which they sold to HDFC Life, I think this is a company which has a very strong balance sheet to do capex going ahead. And probably they've even shown a lot of interest and some technological tie-ups to foray into the electric vehicle battery space as well. So I believe that Exide is doing better as compared to Amar Raja. And recently the lead prices have come down, which should benefit them in terms of the margins as and when they start reporting the numbers going ahead.
Okay. Gaurav, what about you? What is your recommendation on both stocks?
So we are positive on cement sector as such, and this particular counter, Ambuja Cement, was stuck in a range of, in the month of April till June. But since July, it has started a fresh rally. It has resumed its larger uptrend and has given a breakout from a strong medium-term falling trend line. So that indicates that the stock has a potential to head significantly higher. Even the recent dip in the short term was absorbed near its crucial daily moving averages, from where it has started the next move on the upside. So I would suggest add more in the case of Ambuja Cement. I'm expecting the stock to surpass its previous high of around 442 and head towards the level of 480 from medium-term perspective. Coming to Amar Raja Batteries, this stock was a beaten down counter, but it is showing signs of recovery. It has already surpassed its short-term hurdles and is now forming a base above those short-term parameters. So basically, it's forming a base in the range of 500 to 520, and once that base formation is complete, this stock is also expected to start the next move on the upside. So I would suggest hold with a stop loss of 480, expect upside towards 560, and if the level of 560 is taken out, then the stock can head towards 600 as well.
Okay. The next query comes in from Thomas George, who has written to us from Palakkad in Kerala. He has 300 shares of Astra Micro at 117. He's making profits, but wants to know if he should remain invested or if he should book profits right now. Gaurav?
Sorry, I couldn't catch the name.
The query is on Astra Micro. He's making some money over there. He has about 300 shares at 117. So the question is whether he should remain invested in the hope that, he'll make more money, or should he book profits?
I think partial booking of profit is warranted at this point of time because the stock has seen a significant rally, and the short-term momentum indicators are now overbought and likely to get into a short-term correction. The stock can move back towards the zone of 310, 300. So it is better to take some profit off the table, book partial profit, and hold rest of the position with stop loss at 300.
Okay, Parthiv, what about you?
Generally, we have seen Astra Micro kind of always stay in news in terms of some sort of chatter regarding and being an acquisition target. and that's where we see a huge momentum in the stock. Fundamentally speaking, I think over a many period of years since we are tracking this stock, nothing materially has changed in this company. Despite the fact, even recently, I think looking at the way the government is focusing on indigenous defense spending and a lot of these companies getting good orders, I think nothing has turned around for Astra Microwave. So I do agree with the view that no harm post this run up. Definitely, you should book profits and convert your position into some other well-run names, maybe something like a Bharat Electronics Limited, where the visibility in terms of the defense spending and the order book and a lot of products that they do, I think is lot better.
Okay. The final query today comes in from Kishore Ambedkar. He has written in from Mumbai. He has 300 shares of Hindustan Copper, which he has bought at 70. As well, he has 500 shares of IDFC First Bank at 54. Wants to know the future prospects for both investments and what is your advice, Parthiv?
See, Hindustan Copper, I think being a commodity play, one will have to kind of track the commodity copper prices. And if I look at the recent trend, copper has been in a decline. No doubt this as a company has very good ores and has very good profit margins. It's a debt-free company. It's a PSU enterprise. So always there's a buzz about whether the government would have any intentions to privatize this company. If at all something of that sort were to happen, a lot of shareholder value would be created. So I would suggest a hold period for the next 6 to 12 months. Just monitor your position, but do tend to exit as and when you exceed your cost, because these plays tend to even hurt a lot when the commodity down cycle takes place. Talking about IDFC First Bank, I think last quarter was one of the quarters where they reported very clean set of numbers and very encouraging set of numbers, and stock did tend to get re-rated post that because previously I think what we had witnessed was some accounts going bad and they reporting a lot of slippages. So I think that was not helping the confidence at the street level. But now I think the management is very upbeat in its commentary, and they're talking about at least consistency in the next couple of quarters going ahead. So if that were to be the case, I believe one can see better levels, and certainly the bank is doing very well. So definitely hold on to it.
All right, gentlemen, thank you very much for joining in and for advising our viewers. With that, we'll wind up on your stocks for now. Thanks very much for watching. Do stay tuned in. The team of Closing Bell 29.